Hi everyone, I am William. Welcome to this channel. Before I begin, please feel free to subscribe to this channel and on the notification button so that you could receive any new or latest e-learning videos from this channel going forward. Today we are going to delve into a critical component of the financial control environment, auditing the Treasury Middle Office. When we think of Treasury, we often think of the front office, the traders making deals, the rock stars of the trading floor. Or we think of the back office, the settlement teams ensuring cash moves correctly, but sitting squarely in the middle, acting as the crucial bridge and control hub, is the middle office. In the past, the middle office might have been viewed simply as a data entry or trade support function. But in today's world of complex derivatives, high-frequency trading, and stringent regulatory capital requirements, the middle office has evolved. It is now the guardian of integrity between the trade and the ledger. It is the first line of defense against financial and reputational risk. So, why audit it? Because if the middle office fails, the consequences are immediate: inaccurate risk reporting, misstated financials, regulatory breaches, and potentially catastrophic trading losses. Think back to some of the major financial scandals. Many of them involved a breakdown in the very controls that a strong middle office should provide. Over the next couple of minutes, we will walk through a structured approach to auditing this function. We'll cover the key risk areas, the specific controls you need to test, and how to form a value-added opinion on its effectiveness. Before we audit anything, we must define the scope. The middle office can have slightly different responsibilities depending on the organization, but generally, we can define its core functions in 4 pillars. First, trade support and lifecycle management. This is the cradle-to-grave oversight of a trade. It ensures that deals done by the front office are accurately captured in the risk management and accounting systems. Second, profit and loss, or P&L, attribution and validation. The middle office is typically responsible for producing the daily P&L, explaining why it changed, and verifying that it aligns with the risk taken. Third, risk monitoring. They monitor positions against established limits, market risk limits like value at risk or VAR, credit risk limits, and counterparty exposure limits. And fourth, process governance. This includes managing the daily confirmation process with counterparties and ensuring compliance with key regulatory metrics like the leverage ratio or liquidity coverage ratio. Our scope will depend on our risk assessment. If the bank trades exotic derivatives, our focus will be on valuation models. If it has a large collateral management desk, we'll focus on margin calls. The key is to map these processes and understand the flow of data from the trade execution system through the middle office and into the general ledger and risk systems. Now, let's get into the trenches. We'll start with the most sensitive area, valuation and P&L. The front office books a trade at a certain price. The middle office is responsible for revaluing that trade independently, often using a different pricing source or model. This is where we, as auditors, must focus heavily. Our audit procedures here should include, first, independent price verification, or IPV. We need to examine the IPV process. Does the middle office source prices from independent vendors, or are they relying on the trader's own marks? For liquid securities, this is easy. For illiquid Level 3 assets, it's more subjective. We need to review the hierarchy of data sources and test a sample of positions to ensure the marks are reasonable. Any significant differences between the trader's price and the independent verification price, these are reserves or price testing adjustments, must be investigated and approved by management, not the trading desk. Second, we look at P&L explain. A hallmark of a strong control environment is a consistent and logical P&L attribution. The middle office should be able to explain the day's P&L by breaking it down into its components. How much came from market movements, like changes in interest rates or FX? How much came from new trades? How much came from the passage of time, the theta decay on options? As auditors, we should reperform this attribution for a sample of days. If there is a large unexplained P&L, that is a red flag. It could indicate bad data, a model error, or even a rogue trade. We are looking for a clean, transparent line of sight from market moves to bottom-line profit. Moving on to our second major area, risk management and limit monitoring. The Treasury front office operates within a defined risk appetite, expressed through limits. The middle office is the watchdog ensuring those limits aren't breached. When auditing this, we ask, who sets the limits? Usually, it's the risk committee. But who monitors them? The middle office. We need to review the limit framework. Are limits set at the trader level, desk level, and firm level? Our testing involves selecting key limits, like VAR, stop loss, or counterparty exposure limits, and reperforming the monitoring for a period. For every breach we identify in our sample, we need to trace it. Was it escalated immediately? To whom? Was the breach approved retroactively, or was a trade unwound to bring the risk back down? A control breakdown here occurs when breaches are routinely rubber-stamped or quietly ignored. That indicates a weak risk culture, which is a significant finding. The third key area is trade confirmations and settlement support. A trade is not finalized until both parties agree on the terms. The process of matching these terms is confirmation. Delays in confirmation can lead to disputes and, worse, uncollateralized exposure. In our audit, we should analyze the trade confirmation backlog. How many trades are over 30 days old and still unconfirmed? For a well-run shop, this number should be near zero, especially for standard derivatives cleared through central counterparties. For complex OTC derivatives, we look at the use of electronic confirmation platforms like MarketWire. If we see a high volume of manual confirmations via fax or email, that's a control weakness. We also need to look at the Nostro reconciliation process from the middle office's perspective. While the back office might do the reconciliation, the middle office is often responsible for investigating the breaks related to incorrect trade booking. Persistent breaks can indicate systemic booking errors by the front office, which distorts risk reporting. Finally, in our deep dive, we cannot ignore collateral management. In today's derivative markets, collateral is oxygen. The middle office manages the margin calls, the exchange of cash or securities to mitigate counterparty risk. This process is governed by credit support annexes, or CSAs, which are part of the ISDA agreements. Auditing this area involves a few key steps. First, we need to understand the terms of the CSAs. Are they using a zero threshold? What currencies are acceptable as collateral? Are there minimum transfer amounts? Second, we test the operational effectiveness of the margin call process. For a sample of dates and counterparties, we should reperform the calculation of the exposure and compare it to the margin call that was sent or received. Was it accurate? Was it sent on time? Late or inaccurate margin calls create credit risk for the firm. Third, we look at disputes. A log of collateral disputes is a great piece of audit evidence. If there are frequent disputes with a particular counterparty, it could point to poor documentation or incorrect valuations. High dispute volumes tie up capital and create operational drag. Now that we understand the risks, let's talk about the audit life cycle. Phase 1. Planning and risk assessment. We start by walking the floor. We talk to the middle office manager, the heads of risk, and even a few traders to understand their perception of the control environment. We review organization charts to ensure segregation of duties is clear. For example, the person verifying the price should not be the same person who books the trade. We use this information to tailor our program. Phase 2. Control design and implementation. We document the processes, often through flowcharts. We ask, what is the control that prevents or detects an error? For instance, the system automatically blocks trades that exceed trader limits is a preventive control. A daily review of the stale confirmation report is a detective control. We assess whether the design of these controls is actually capable of preventing a material misstatement. Phase 3. Operating effectiveness testing. This is the proof in the pudding. We select a sample and test the controls. We look at evidence. Show me the signed limit breach report. Show me the IPv spreadsheet with the manager's sign-off. Show me the email thread disputing that collateral call. We are looking for exceptions. 1 or 2 minor errors are a deficiency. A systematic failure to follow process is a material weakness. Phase 4. Reporting. Finally, we bring it all together. Our audit report shouldn't just be a checklist of findings. It should tell a story about the health of the middle office. Are the risks increasing? Is the technology outdated? Are there staffing shortages leading to errors? Our findings should provide management with a roadmap for improvement. No audit of a modern treasury would be complete without considering technology. The middle office is rapidly automating. Robotic Process Automation, or RPA, is now handling trade confirmations and data entry. Machine learning is being used to detect anomalies in P&L. As auditors, we have to adapt. We can't just look at a screen printout anymore. We need auditors with IT audit skills to assess the logic of these bots and the governance over algorithm changes. We need to test the data integrity feeding these systems. The risks are shifting from manual human error to automated systematic error. If a bot is programmed wrong, it can break thousands of trades before anyone notices. In conclusion, auditing the Treasury Middle Office is a dynamic and critical engagement. It requires us to be part financial auditor, part risk manager, and part technologist. By focusing on the core pillars, independent valuation, P&L attribution, risk limit monitoring, and collateral management, we can provide assurance that this vital control function is operating as intended. Remember, the middle office is the glue that holds the Treasury together. When it works well, the business can take risk confidently. When it fails, the cracks appear fast. Our job is to ensure that glue is strong. Thank you for your time and attention. If you found this video is useful, please feel free to subscribe to this channel so that you will receive any new or latest e-learning videos from this channel seamlessly. Thanks again, and have a great day ahead.